Good afternoon and welcome to the Investors Management Group Q3 2020 Asset Management Webcast for Whitehall Estates. We appreciate you joining with us today. Our webcast for Q3 will present an overview of your investment with us over the most recent quarter. Today we'll discuss the operating performance of Whitehall in a review of reserves, income collections, performance to this year's budget, as well as discussion of specific qualities of the property and its market. We appreciate your confidence in IMG in our role as asset manager, and we hope that today's conversation delivers useful detail and context to understanding your real estate investment. The hosts of today's webcast are Michelle Rivnick, Managing Director of Asset Management, and myself, Dave Mickelson, Investor Relations Manager. I'll quickly cover a few technical features of our webcast. First, all participants will be in listen-only mode to allow for clear audio. Second, I'll encourage you to submit questions during the webcast. If you're with us on the web, you can send your question in the chat pane. If you're with us with an audio call or at your computer, you can send questions via email to investor.relations@imgre.com. I will collect questions during the presentation, and then Michelle and I will address those during the question and answer segment at the end of the call. With that introduction, I'll turn it over to Michelle to review property operations.
Thank you, Dave, and thank you all for joining us today. We'd like to start here with our reserve summary, and you can see that this information is as of September 30th, and it's broken into owner-controlled reserves and lender-controlled reserves. Our top line is our operating account, and it currently has a balance of $420,610. And then we have a capital reserve, which is also owner-controlled in the amount of $1,276,300. From there, that combines for our total owner reserve at $1,696,910. If you look below that, you see our lender-controlled funds. We do have a replacement reserve with the amount of $247,000. That's an account that we pay into on a monthly basis. As we complete repairs, we submit a draw and are reimbursed for those expenses. Our CapEx reserve held by the lender is $1,365,000. And then our real estate tax, insurance, and rate cap escrow combines for $329,784. Combined lender-held reserves is $1,941,000, and our owner plus lender-controlled reserves is in the amount of $3,638,709. I'd like to pause here briefly and just kind of touch on these balances, especially the CapEx, these larger balances that we had projects in place. Now, as we closed on Whitehall, we were immediately impacted by COVID and have really had to do this transition under a completely different operations mindset than we ever had to do before. So we did hold off on the capital projects. We've done a few things. We've done a cleanup of the landscape. We've done power washing. We've done some landscape upgrades, tree removals, things like that. We've done some asphalt projects just for the asset preservation type of things that needed to be done. As far as upgrades to unit interiors, we have not taken that on yet. Few reasons is during the COVID impact, we were seeing a higher demand on that price point versus people looking for more of that luxury interior unit renovation. So we stayed with that. We are still getting about $40 to $50 average in increases on rent trade outs when a resident moves out versus the new one moving in. So our market rents are moving in the right direction. But until things kind of settle down operationally, and a few things that we'll kind of hit on as I speak through our operations, it will probably pick that unit interior renovations up in spring of 2021, where I expect there just to be a much higher demand. So that's just kind of a brief overview right there. But I would like to talk about our collections so you can kind of see why we're making the decisions that we are. So here is 6 months of our collections so that you can see the trending and see kind of why we held on some projects and why we wanted to be very conservative as we move forward. We didn't have a lot of history on this property, so we also wanted to find out for ourselves what the trending would be. So here you can see 2 quarters of collections information, and if we look at April, you can see that our rents billed was $259,798. Of that, we collected 95%, which is $246,800. Now, as you move down, you can see we went from 95% to 96, and then started to dip here in June at 93. July is where you'll notice that it kind of coincides with the unemployment had an additional $600 per week. July is when that ran out. And then you're going to see that 88, 86%. Now, during that time, we have increased our market rates. So that was moving in the right direction. So the newer folks that were moving in had higher rates. But the rent collected was slightly lower. Now, one note about the September rent, that number is as of the end of September the 30th. So there's a great chance that we've received rents in October that will be allocated towards September, and we will reconcile that as we close the books for October. And we'll keep you posted on to see if that 86 goes up to an 87 or 88%. Another way to look at this information is in a graph to help us visualize what does that mean and where our trending is. So the dark blue bar you can see moving is in the right direction. This is our market rents. This is what we are advertising to all new residents, and we're leasing, and things are going well there. However, you can see that this rents collected compared to the rents billed has definitely plateaued. So there's a difference here between this rents billed and this rents collected. And I really want to talk to you about how that works from an accounting standpoint, how you're seeing this on your reporting, and how this impacts our operations and numbers going forward. So the difference between our rents billed and our rents collected becomes our accounts receivable, or our AR. Now, the accounts receivable sits on the balance sheet. So as we bill these rents out and they are not paid, you'll see month over month, the AR balance is accruing and accumulating. Now, in the past, this wouldn't be too much of a problem. We generally have never even spoken about this topic before, but we run into concerns because of all of the eviction moratoriums. Now, in the past, if we had a resident that wasn't paying, we would simply put them through the eviction process, regain possession of the apartment, and release it to a new qualified paying resident. With the CARES Act and now the additional CDC moratorium, we've run into this point where the residents can't pay and we're not allowed to do these evictions, which creates AR. So I wanted to walk you through this number just so you're aware of it. What happens is when we get a unit back, whether the resident is evicted or they just surrender possession, that's when we're able to take that AR amount that's sitting on the balance sheet and it gets moved over to the operating statement, where then you would see it on your monthly reports as a write-off as bad debt. So as the bad debt number hits on the income side, the AR balance is reduced. And that's how that works on your reporting. As I said, we haven't been able to do the evictions, therefore it doesn't go to bad debt yet, and it's just still accumulating on your balance sheet in AR. Let me walk you through a little bit of where these residents are and how we're handling these balances. As of October 26th, we have 17 units that are in eviction, and they combine for $67,000. So far, we're able to move forward with these, and it doesn't seem to be an issue that will get any resistance from the city or the state. Things are moving forward. And then we have 5 residents that are on payment plans. So these are folks that we actually do expect to have them pay off their balance. So that AR will be reduced by their payments versus being sent over and written off as bad debt. So we do anticipate receiving that. Now, the one piece of really good news that I'd like to report is that the state of North Carolina has stepped in and created a program to help this specific problem, because this isn't just for our Whitehall, it's for all properties, across the country. Different states are handling things differently. This information just came out that they've created a program. It's called the HOPE program. And what that does is it allows a resident to apply through the state. The state is funded by the federal for HUD and from the coronavirus relief fund. So that's where that North Carolina kind of bank is being funded from. The residents are able to apply for assistance, and they can receive up to 6 months of rental payments. So the one highlight about this is that the payment does not go to the resident, it goes to the landlord. So the property management company that we have on site would be involved in this process for each resident. They would sign off and they would receive the check. So like I said, this is a brand new program. We're really excited that North Carolina has stepped up. We've seen this in some other states where if the local municipalities are helping, our bad debt problem is nowhere near any kind of concern. So we will be working with our residents to circulate the information about this program, and hopefully that will really help to resolve this bad debt that we have right now. Otherwise, if residents are not qualified, we will move forward with the eviction process to regain possession of the apartments. So I know that's a lot of information, but I wanted to make that kind of pretty clear on what we're doing and what that situation looks like. From there, I can take you to our budget review, just to do an overview of our Q3 and 2020 year to date, and just to kind of see how things are going. So for our income, we are just slightly under budget at a negative variance of 0.8%. Our other income was impacted by $24,000 specifically for not being able to charge any late fees or legal fees that we had anticipated. This budget was written before any type of COVID impact, so we had no expectation of that. So that's where you're seeing that main driver. When you look at expenses, our utility expenses were $46,000 under budget expectations. Again, it's kind of from our underwriting and really understanding the trend and how this property is going to work. So we will tighten that up for the 2021 operating budget. And we do have a temporary savings in landscape at about $22,000, but that is actually on par to be spent in Q4 to mulch and pine straw throughout the property, just for curb appeal and maintenance. Now you can also see that our debt service, we have a very good savings here of year to date 30%. And this is due to the falling rates that we've seen basically since we've closed on this property. And that is an overview of our collections and our operations and budget. And with that, I would like to hand it back over to Dave, and he will talk with us about key metrics.
Okay, thank you, Michelle. Well, this slide is becoming more familiar to you as we go through these quarterly calls. The break-even analysis has been one of the measuring tools that we've used this year with, some volatility at operations and some unexpected shocks and surprises like the collections numbers that Michelle mentioned. But this has been a nice kind of a snapshot of the health and the performance of the property, and able to combine some variables into one and make sense of the numbers. So as a recap, to arrive at this break-even income, what we do is take trailing actual operations to arrive at a baseline, and then we stress that to find the cash flow break-even point. And in this analysis, there are probably three primary variables. One is the physical occupancy number that's here at the top, and that is relevant because it's an indicator for the total rent billings that are available to us. The second primary variable would be the collections percentage. In other words, the metric for what proportion of those people being billed are paying and we're receiving those rents. And then the third variable that's been key has been the debt service expense. That's a figure that it's tied to our variable rate loan, so that can rise or fall month to month based on the loan index. And for us, it's moved very favorably this year. We're down more than a percentage point since Q1, and we've seen that movement between Q1 to Q2 pretty dramatically, and then here from Q2 to Q3 kind of mildly dropped, and here I think we've reached maybe a floor, and hopefully we can stay here for quite a while. But bringing these three and tying them back together, let's kind of make sense of how they interplay and what the result is with the cash flow and ultimately the owner distributions. So first, with the physical occupancy, we're trying to maximize the billings again, partially as an offset for some of the collection loss that we're expecting here. Partially, as we get more full, we've got rent leverage and we're able to raise rents and have more pricing power on how we price the units. So here in Q3, we've operated very well, 98%, 97%, 96%. This property, since we've acquired it, has been a great performer physically. I think with physical occupancy never really dropping below 95%. So this is a good quarter and what we've come to expect from Whitehall. As you saw on some prior slides, our collections as a percentage of build has dropped. We were in the mid-90s back in Q2, and that's come down to the high 80s here in Q3. So that's been kind of a battle that we've been waging and using some creative tactics in order to, keep a balance and keep the collections coming in. Michelle's talked about that, and I'll touch on that a little bit later. But here on this slide, to summarize, you can see the actual net collections are running between $255,000 in July and August to about $247,000 in September. And then with our expenses being on a pretty straight line, pretty consistent, and then our debt service here at these low levels, our positive variance over break even has been in the $71,000 to $77,000 per month range here for Q3. What that ultimately translates to is the cash flow to investors. Over this quarter, we've paid a 5% cash-on-cash return based on the great operations and some really positive outlooks as we go forward. We plan to increase that, and I'll talk about that as we talk in more detail about the property. Moving on, I want to touch quickly on some of the dynamics in the state economy, and here our region in the Charlotte metro that are kind of mixed. Some of it is weighing a little bit against us, but a lot of it is going in our favor. Michelle talked about some of the difficulties and challenges with the evictions. Mecklenburg County, fortunately, has been a county and a state where they haven't had their own eviction moratorium. So we've been operating under first the CARES Act and now the CDC moratorium that goes through the end of the year. With the executive order from the governor, that's provided some more resources and kind of encouragement for tenants to use the declaration to prevent an eviction. So that's been a little bit challenging. We do have evictions in progress, but we also have some declarations filed that protects tenants at least through the end of the year. Then also, Michelle mentioned the great news about the state resources that are going to go into effect, and we hope to draw from those and catch up on some delinquent rents from renters who are in need. So that's some of the political backdrop that we're working within here in North Carolina. Charlotte as a metro ranks very, very strong as a national multifamily market and as a general real estate market. Taking information from the ULI 2021 Emerging Trends Report, they rate Charlotte as the number 5 market nationally and a strong buy for those who are both investors and operators in multifamily. That's great because it suggests really strong demand for acquisitions, strong volume and transactions, and really a boost in value as we go through time if this remains a top investment market like it should. Economic fundamentals for the area are projected to be very strong. From the ULI report again, they're projecting almost 4% employment growth over the next 5 years annually. as well as in-migration of about 60,000 people per year over the next 5 years. Those are two of the key drivers for multifamily performance, and so it's very positive to see that here. Moving to property updates, just a couple recaps on things that Michelle and I have touched on in more detail earlier. But the goals here as we move into Q4 and into 2021, we'll be keeping a high physical occupancy, trying to remain over the 95 to 97%. That gives us pricing leverage. It allows us to maximize our billings. And then with the accounts receivable, those have grown. But if we can be communicative with our tenants and be creative, whether that means using payment plans, whether it means reaching out to community and state resources to help tenants and support them in receiving payment from them, doing what we can to cycle non-payers through, bring in payers through the eviction process. Those are all tools that we're using and managing the AR the best that we can. The variable interest rate should benefit us through at least Q1 2023. That's based on economic projections for the SOFR curve, which our loan is indexed to. And then finally, a great piece of positive news, beginning next week with the November distribution, those distribution rates will increase from the current rate of 5% to a rate of 5.75%. And that'll hold into the foreseeable future. And of course, as performance improves and as the market kind of regains its footing and gets back on standard ground, I would love to raise that rate as we can into the future. Lastly, I'll touch on just a couple of national dynamics and how that compares and contrasts with our property. The eviction moratoriums have been huge, both at a national and statewide basis. Really looking forward to having the national moratorium expire this year and being able to operate, without restriction again next year in a more normal course of operations. Tenant employment has been key. It's been those tenants who are employed who can pay rent now that the federal employment benefits have expired. So if federal stimulus comes back, maybe later this year or maybe next year, that would also certainly be a big boost to us, because we saw with the federal stimulus in effect in Q2, our collection rates were higher. That money was flowing through and coming to us as rent payments. So we'll hope that is part of the package with the next administration, and look forward to any kind of relief we can through that federal means. Then the last couple points here, the challenges that we're facing with the collection percentages dipping is not unique to us at Whitehall or in Charlotte. That's been something that's been a huge piece of news across the multifamily industry this year. And reports are that, collections are down 2 or 3 percentage points across rental housing this year. And really interestingly too, on this last point, rents for the first time since 2009, so more than a decade, in the first time in this cycle, rents have declined, and that occurred in Q2. And that right there is a signal for just how competitive the market is for properties to attract and then capture with leases tenants who've got the credit intact and who have the capacity to pay rent. So it's a nationwide challenge. I think we're operating well, using the resources that we can, and great staff at the site level and asset management level, and doing well despite some of the challenges. Well, that will take us to the end of our prepared slide presentation, and it brings us to the question and answer segment of the call. If you'd like to submit a question, you can still do that either in the chat pane or an email to me at investor.relations@imgre.com. We received a number of questions so far, so we'll start addressing those, and I'll be on the lookout for more if you'd like to send those here in the next few minutes as we talk through. So let's jump right into our questions. So this first question to Michelle. Michelle, why was the September rent billing lower than August?
Sure, I can answer that. If you want to, if we could hop back to slide 8 for the key metrics, this answers your question here. the key metrics. There we go. Perfect. So you can see it's occupancy. So our billed rents, if a unit is not occupied, then we would not bill those rents. And you can see that from July, we were occupied at 98% at the end of the month, August 97.2, and then 96. So that would really reflect that number. Also, you're going to see a little fluctuation in rents billed as we change market rents a little bit. We may have a floor plan that's sitting and we want to lower the rent on it by $20 or $30. You'll see that that little impact will be there too. So it's just a combination of those two items.
Excellent. Thank you for that. And we'll pause on this page because the next question lines up well with the metrics here. The question is, how low can collections go before Whitehall is unable to pay expenses? Fantastic question. That's answered here with the break-even analysis. And so if we take September, for example, and we see that the break-even net collections would have to be $175,913 in order to pay all expenses and debt service. That's, I think, mid 60% of billings. So that's kind of the ballpark of where collections would have to fall, mid 60s, and right now we're in the upper to mid 80s, and trying to push that obviously to the mid 90s and above. So that's the answer there. Here's another question while we're on the slide, and this goes back to Michelle. For July and September rent, that rent bill was similar, but August was higher. I'm not sure if I quite understand that question as I read it. Maybe we'll skip that one.
Let me
that one, Michelle.
Yeah, let me jump in on that one. So the pricing is going to fluctuate, and then depending on move-ins and move-outs. So it gets a little bit in the weeds, but let me try here. So you can have an occupancy that's higher, but say you have smaller apartments that have lower rents, or you can have larger apartments that have higher rents, things that are renovated already and you're charging a higher amount for. So if you have residents move out of larger units at higher rates, and then your move-ins just so happen to be smaller units, you would still see the same amount of occupancy, but the billing would be slightly different depending on the actual type of floor plan. So each floor plan is amenity price driven. So if it has a better view, it's this amount. If it's got better cabinets, it has this amount. But perhaps if it faces, the parking lot or a dumpster, it may be a slightly lower amount. So each unit is priced individually, and depending on who's moving out of which units and then moving into others, you will see a fluctuation in those rents billed.
Good. I'm glad there's somebody a lot smarter on this call to answer questions. Thank you, Michelle. Very nice. Well, another couple of questions, and I think we can tie these together if we go back to the accounts receivable slide. And so let me send these two questions to Michelle. One is, what's the total dollars in accounts receivable now? And as you can see from the slide, it's slightly over 70,000. And then for Michelle, what are we doing to offer delinquent residents some kind of incentive to move out? Are there tenants who might accept something in return for moving out in order for us to get paying tenants to move in? Maybe do you want to talk about some of the rent forgiveness in exchange for keys that we do?
Sure. So we take on each resident case by case, and we really try to understand where they're at, what can they do, and how can we have a win-win situation. In some properties we've offered amnesty of give us the keys and we'll wipe away your bad debt, and it's worked. And some properties it just hasn't worked. We've offered it. We do, even if it's like a price break, if you can pay this amount, we'll hold that amount. We've offered a few $100s here and there. We've tried so many different things because we had our hands tied for a while of not being able to do any evictions. The problem runs into, does that resident have somewhere else to go? And if the answer is no, there's really no part of a negotiation that we can leverage. And again, if we weren't able to evict and actually motivate these folks, then they had just the ability to stay in the apartment. So each property has a delinquency report. It shows any resident that has past due amounts. The site teams reach out to them, call them, email them, knock on their door, and do everything we can to try to get possession of that apartment back. And the worst case scenario is we have to move towards eviction. So yes, we've tried. We've had some here and there to skip, we call it a skip, and just leave us the keys, which is great. You see that AR come off, but that's offset by anyone else accumulating an AR into the next month. But you can see, if you look at July, August, and September on this slide we're seeing right now with the accounts receivable, there hasn't been a huge amount of growth. And that's because we have been getting some units back and have been wiping away that bad debt, moving it to bad debt as possible, versus the jump you see in May and June. So anything we can do, we are trying. It's everybody's goal to get possession back of these apartments. And we do what we can. And when we can't, we have to go towards eviction.
Very good. And how about one more question I'll squeeze in? It's kind of technical. It's about how we write off rent receivables. So if you want to answer in a few sentences, when a tenant moves out, that's when we book the bad debt. What's the process, practically speaking, of writing that off versus collection efforts that continue after that person moves out?
So when we write it off, when it's an eviction, we've already tried everything we can under the sun for the in-house team to try to collect that money. So when we get an eviction, we write that amount off and their account gets sent to a collection company. If after that point we do receive some money, you'll see that on the statement as bad debt recovery. If a person moves out, not an eviction scenario, say they only owe $500, maybe they left the unit in really bad condition, we would try to collect in-house for 30 days before we send them to collection. But all in all, at the end of the day, every account does go to a collection company eventually to try to get that collected.
Excellent. Thanks for taking us into the details of property management. Appreciate it, Michelle. Well, very good. Thanks to everybody on the call for your participation today. The slides that we covered here and the audio recording of today's webcast will be posted and available to you in the next few days at your investor portal. You're always welcome to get in touch with me or Michelle with any other questions. We appreciate your partnership with us in Whitehall as we continue operating through the housing market and the economy. We look forward to hosting our next webcast in January for a full recap of the year 2020. This will conclude our Q3 webcast. Have a great day.